Aaron, I'll start with you. We were talking earlier, I'm sure a lot of your clients as well. When's this going to end? What do I need to do? What's an appropriate multiple? What do you tell them on a day like today in particular, where especially sort of technology-related growth companies are just getting crushed?
Yeah, no, it is a tough environment right now. Obviously, we've rising inflation concerns, concerns around earnings coming down possibly. We think in this environment, investors are sticking with names that are producing kind of free cash flow, reasonable multiples, kind of the GARPy names, growth at a reasonable price. For us, that's kind of Google or Alphabet, which is trading around 20 times earnings on 2022 on GAAP earnings. Meta or Facebook around 16 times earnings. We have companies like GoDaddy trading at 13 times cash flow in terms of a mid-cap name. So we think investors are gravitating towards names that have real free cash flow. There is quite increasing concern on stock-based comp as well in this space. But yeah, we think investors are best suited right now to stick with companies that have reasonable valuations and have solid balance sheets as well.
Aaron, you just mentioned something. Let's explore it a little bit. Stock-based comp. You said increasing conversation around it. What are the conversations like? Obviously, I could imagine, given the value of that stock is a lot less, and it may require the companies to come up with a lot more cash to pay their people.
Yeah, and I think that is a concern. I think in a bull market, investors will kind of discount SBC, focus on revenue growth. In a bear market or when names are trading off and there's more valuation concerns, investors start to view stock-based comp as a real expense. Companies may have to re-up some of their employees, either on cash or offer new stock, which could be dilutive to shareholders. So that is becoming a concern right now for some of our companies right now.
Barton, in terms of the macro and how it filters into your coverage universe, there's some talk out there, of course, that consumer sensitivity to what they're spending on streaming services all of a sudden could become an issue. It's no longer an open-ended growth story. Is that reflected in your stocks? Do you think that's going to be an ongoing further concern?
Look, I think that this potential recession is something that is something we're trying to digest the environment, right? So historically, entertainment was a safe harbor. People would hang on to their pay TV subscription. What will happen with streaming if we go into a recession? My bet would be that it'll be somewhat similar, that this will be a safe harbor. But we've got so many streaming services, there might be some winnowing down. I think that environment, Netflix is probably better positioned because they've been the first service that you've signed up for, and they're probably the one that you're using the most based on the usage data we see, across many people. On average, they're the most used. So, that is a setup that I think will be new, but that would be my guess about how it would break.